Hello, all. Our topic for today is time value of money, present value, and future value. Well, this course is an introduction to time value of money as it relates to decision making to help you understand the basics of finance. Time value of money is a basic and important concept in finance theory as it affects financial decisions. It basically involves the concept of compounding and discounting. Well, the course outline we are looking at are the concept of time value of money, the role of time value of money in finance, concept of present value, concept of future value, difference between future value and present value, simple interest, compound interest, and lastly, concept of APR, APY, and EAR. Course objective. At the end of this course, you should be able to understand the concept of time value of money, the concept of present value, future value, simple interest, and compound interest. And finally, understand the application of time value of money in real life scenarios. So what is time value of money? Well, basically, time value of money is just a basic concept that says the the purchasing power of today is higher than the purchasing power of tomorrow. That is, a certain amount of money has different buying power or value at different points in time. And the concept is all about a fund at hand now has more value than a fund to be received in future. So because money has time value, it gives rise to a concept called the concept of interest. So interest is like the rental fee for making use of money. So we can relate it to, let's assume uh, 5,000 naira was borrowed for a year at 10% interest. So the at 10% interest, the rental fee paid is 500 naira, which is 10% of 5,000 naira. So this concept gives rise to what we call the simple interest and the compound interest. So there are three reasons why a naira at hand now or a fund at hand now is worth more than a fund at hand in future. And one of the reasons is the purchasing power and inflation. As we know, inflation is the general increase in prices of goods and services. So let's assume 100 naira at hand now will purchase more items than waiting for a year from now to purchase those items due to inflation. Then the second reason for time value of money is the investment or the rate of return. Well, a certain amount invested now will have more value and you get a better return than you waiting maybe in 6 months time to invest such fund. And the third reason is the uncertainty. Well, as at now, you are certain that you are going to receive a particular fund, unlike a promise to receive such fund in future. So with this, people with this, there is uncertainty of not receiving the money at all after waiting for a certain period. So to avoid the uncertainty or the risk of non-payment, we would like to get the money as soon as possible. So role of time value of money in finance. Well, basically the application of time value of money in finance is in the area of compounding and discounting. Well, compounding and discounting give rise to what we know as the future value and the present value. Then the concept of simple interest and compound interest. As we said earlier on, interest could be described as cost of borrowing or simply rental fee for making use of another person's assets, or a fee a borrower pays to a lender for a loan. And it is usually expressed as a percentage, and it can either be simple or compounded. Then simple interest is basically calculated on the principal amount of a loan or a deposit. Well, the formula for a simple interest is just the principal amount times the interest paid, the interest rate, and times the time, or what we call the term loan. For example, this is just a basic example on simple interest. Suppose Mr. Muritala opened a fixed deposit account of amount 5 million naira with Chop Life Bank that pays an interest of 3% per annum. What is the interest earned after 1 year? And what is the interest earned after 4 months? Well, from here, our principal is the 5 million naira, while the interest rate is the 3% per annum, and the time or term loan is 1 year. So the formula for simple interest is P times R times T, in which our P is the principal amount, our R is the interest rate, and our T is the time. So from here, 5 million naira times 3% times 1, which gives rise to, or which gives us 150,000 naira as the interest earned after 1 year. Then the interest earned after 4 months, we'll just substitute the time in our previous calculation, in which our previous calculation time was 1, while this one now will be substituted for 4. However, the interest rate is per annum. So we are to prorate, since we are given 4 months, we are to prorate the 1 year, which is the interest rate, into monthly rates. And so this gives rise to simple interest is equals to 5 million times 3% times 4 over 12. So after 4 months, our interest that is supposed to be earned will be 50,000 naira. So we'll move on to the next slide, which is the compound interest. Well, earlier on we said simple interest is a percentage on a particular amount or a principal amount. But compound interest, is based on the principal amount and the interest that accumulates on every period. So basically, compound interest is calculated by adding the simple interest of a period to the principal amount in order to get interest for another period. So it's just the interest is compound interest is a interest of a simple interest on principal amount to give us a new principal that will be used in calculating another interest for another period. So with compound interest, borrowers must pay interest on the interest as well as the principal. So the formula for compound interest is principal into brackets 1 plus the annual interest rate raised to power t minus principal. So this is a typical example. Suppose Mr. Muritala took a loan of amount 5 million naira with Chop Life Bank that pays an interest of 3% per annum compounded annually. What interests Mr. Muritala would have paid after 3 years? Our principal amount is 5 million, while our rate is 3%, and the time or the tenure is 3 years. So just plug in all these values into our formula. Our P is 5 million into brackets 1 plus R, which is 3%, and is the same thing as 0.03 raised to power 3 minus 5 million. So the compound interest after 3 years is the interest that would have accumulated or compounded after 3 years is 463,635 naira. So earlier on, we talked about interest rate as a rental fee on the usage of a particular asset, which can either be deposit or loan. So an interest rate gives rise to what we call another concept known as the concept of APR, APY, and EAR. So aside interest rates, which represent cost of borrowing, there are other forms of interest rate like APR, APY, and EAR that always apply to different financial products. APR is the cost of borrowing, while APY is the amount earned on an investment or deposit. However, each term is similar. There are significant differences between them which can affect finances and financial decision making. Well, APR is known as annual percentage rate, and it represents cost of borrowing, and it differs from interest rate in the sense that all applicable fees must be charged along with the interest rate. So this one is trying to tell us that APR is similar to what we all know as interest rate, but what makes it different from interest rate is that all incidental charges pertaining to borrowing of money will be included in calculating the APR. So the rate gives the actual amount that will be charged for borrowing, and it does not account for compounding factor. So APR only uses simple interest factor. It does not use compounding factor, while APY makes use of the compounding factor. And APR is usually applicable to mortgages, mortgage loans, and auto loans. So the difference between interest rate and APR is that interest rate is a percentage paid on borrowed money, while APR is only on borrowed money and takes the consideration of interest rate and other applicable fees associated with the borrowed money. Then we have what we call the APY, which is the annual percentage yield, and this represents amount to be earned on investment products like savings accounts, money market accounts, or certificate of deposit. And APY always factor in compound interest of compounding factor. So the difference between APR and APY is APR is usually applied to mortgage loans and auto loans, while APY is usually applied to financial products like savings accounts, deposits, the money market account, the treasury bill, certificate of deposit, etc. And also we have what we call EAR, which is the effective annualized rate. APR and EAR are similar. However, the only difference is that EAR is an APR that takes effect of compounding. So basically the difference between APR and AER is EAR factors in compounding, while APR does not factor in compounding factor. And EAR is usually applied to or is applicable to credit card payment. Then we have what we call compounding. And compounding represents the conversion of a current amount of money into a future amount of money. So compounding is you trying to convert what is basically like you trying to convert or try to know what you will earn from future as a result of your present earning today. So you can predict your future, earning from what you are earning today. And the compounding factor is 1 plus r raised to power n. So compounding, we have two types of compounding. We have what we call the discrete compounding and the continuous compounding. So the discrete compounding is used to show the frequency of compounding, which are, for example, bi-monthly, biannual, quarterly, etc. And the discrete compounding factor is bracket 1 plus r over m, close the bracket, raised to power mn. Then the present value of continuous compounding is future value, which is our FV, is equals to present value, which is our PV, into bracket 1 plus R over M into bracket Mn. So this discrete compounding is all about the frequency of compounding. As we know, compounding is usually a year, but there are instances where it can be stated that it should be done monthly, biannually, or quarterly. So discrete compounding takes in the effect of the frequency of compounding. Then we have what we call the continuous compounding. So this is when frequency of compounding is done indefinitely. That is, there is no time lag or time frame for the frequency of compounding. So this is when the frequency of compounding is done into foreseeable future. It's done indefinitely. And the compounding factor for continuous compounding factor is E, which is our log raised to power in. Then this is the future value of the continuous compounding, which is FV is equals to PV e raised to power n, where our E is the Euler constant. Then we have discounting. So discounting is the technique that calculates the present value of a future sum of money that can be received or paid. So discounting is when you know what you are supposed to earn in future. Your future earning is already known, but you don't know your present earning. So the process of converting your future earning to your present earning is called discounting. So discounting requires computing the discounted value of amount of money that are going to be received at future moments in time. And this is the discounting factor, 1 all over 1 plus r raised to power n. So discounting is the opposite of compounding. Then this is the formula for the future value of a single sum. FV is equals to PV into brackets 1 plus r raised to power n, where our FV is the future value, PV is the present value, r is the rate of return, n is the number of years, then 1 plus r raised to power n is the compounding factor. Then we have the discount rate and the compounding frequency. This is the formula to calculate the discount rate. But before you can calculate the discount rate, you'll be given the future value, the present value, and the frequency of the compounding. Likewise, to get the frequency of compounding, this is the formula. N is equals to ln future value over present value all over ln 1 plus r. So this is our formula for the present value of a single sum, as you can see on the slide. Then we also have what we call annuity. Well, annuity is a series of equal payments at fixed intervals for a specified number of periods, that is monthly, weekly, yearly, etc. So annuity is when you have a series or equal cash flow or equal payments to be received or paid for a specified number of periods. So, and we have the two types of annuity. We have the annuity due and the ordinary annuity. The ordinary annuity is also known as deferred annuity. So ordinary annuity is an equal series of payments received or paid at the end of each period. So ordinary annuity is when you are to pay or receive an equal cash flow or equal series of payments at the end of each period. And this is the formula for the future value of ordinary annuity. Likewise, this is the formula for the present value of ordinary annuity. So we have the annuity due. Well, annuity due is the series of equal payments received or paid at the beginning of each period. So the difference between annuity due and ordinary annuity is that both of and one is received, one is being done at the end of the period, while the other one is at the beginning of a period. So annuity due is at the beginning of each period, while ordinary annuity is at the end of each period. Then we have what we call perpetuity. Perpetuity and annuity, they are similar. The only difference is perpetuity has a limited, has an unlimited tenure or time, while annuity has a limited time. That is, there's a definite for annuity, there's a definite period that the equal sum of amounts will be paid or received. While perpetuity, there is no definite time or period for the payment to be received, for the cash flow to be received or paid. So a perpetuity is a stream of payment that continues forever. So the computation of a perpetuity is straightforward, and is the present value of a perpetuity is the payment divided by discount rate. So this is the formula. The constant payment over the discount rate will give us the present value of perpetuity. So these are the typical real life examples on future value, present value, discounting, compounding, annuity, and perpetuity. So Mr. Muritala, a banker who works with Chop Life Bank, he has been in employment of the bank for 4 years, and his annual salary since employment is 5 million naira per annum. However, Chop Life Bank has a promotion policy of promoting staff every 60 months. Oxford Estate Property came to Chop Life Bank to make presentation on acquisition of affordable housing. Mr. Muritala is interested in buying one of the houses which cost 20 million naira, which he cannot afford now. However, Mr. Muritala felt that with his current salary and expected promotion next year, he could afford the purchase of the house in 5 years' time. So if the expected inflation rate as applied to the price of this house is 6% per year, what is his expected price after 5 years? So from this scenario, our present value is 20 million naira, which is the cost of the house for now, as at now. And the inflation rate, which is the same thing as our discount rate, is the 6%. And our N, which is the tenor, is 5. Is 5. Oh. So the future value formula is a PV into brackets 1 plus R close brackets raised to power n. So which is equals to plug in all our variables, our PV, R, and N into the formula. So the future value amount is 26,764,511.55 kobo. So this is another example. Well, after receiving performance of 850,000 naira, Mr. Muritala decided to purchase a SUV that worth 1,850,000 naira. However, Mr. Muritala needed to borrow 1 million from his sister to make up the SUV purchase price and promised to pay her 1,350,000 after 3 years. With annual compounding, find the implied rate of interest for this loan. So you can see the calculation on the slide. Our future value is 1,350,000, present value is 1 million, and our N is 3. So just plug in all these values into the formula. So from here, after 3 years, the implied rate, the future value amount will be 26 million. So sorry, there was a slight mix-up in the slide. So we'll now go back to the real life scenario. Well, this is another typical real life scenario. Mr. Muritala opened a variable interest money market fund account with 2 million naira deposits. The account compounds the interest monthly. Then Mr. Muritala expects the interest rate to remain at 8% annually for the first 2 months, 9% annually for the next 4 months, and then back to 8% annually for the next 3 months. Find the total amount in these accounts after 9 months. So this is our R1, which is our first rate, 8%. Then R2, 9%. So since our rate is in year and we have to use a typical example of discrete compounding, which shows the frequency of the compounding. So the interest rate will be prorated to monthly rate. So just divide the interest rate by 12 to get the monthly rate. So then our future value is this 22 million into brackets 1 plus 0.08 divided by 12 raised to power 2 into brackets 1 plus 0.09 divided by 12 raised to power 4 into bracket 1 plus 0.08 divided by raised to power 3. So, and this will give us the future value, which is 2,130,185 naira 10 kobo. So this is another example. Mr. Muritala decided to put 5 million naira in a money market fund that pays interest at the annual rate of 12%, compounding it monthly. Then Mr. Muritala planned to make the money out after 1 year. He is expected to pay 1% management fee and 50% tax on interest earned. Find the total amount available to Mr. Muritala. So we can see it on the slide. This is a calculation. Our present value is 5 million. The rate is 12%. The tax is 15% and the management fee is 1%. So this is the formula. FV is equals to PV bracket 1 plus R raised to power N. FV is equals to 5 million into bracket 1 plus 0.12 divided by 12 raised to power 12. So our future value is this. Then the interest earned is a future value minus present value, which we have this figure. So you take effect of all the management fee, what else? The management fee and the interest. So with this, you have this as your final answer. Then this is another example. Mr. Muritala, after working for 5 years, expect to receive performer bonus of 850,000, while his salary after promotion will be 7,386,000 naira. Then, what rate did a Chop Life Bank use in arriving at the performance bonus? So we have our future value to be 850,000 naira, the present value to be 7,386,000 naira, our N 5. Then we are told to calculate the R, which is the rate used in getting the performance bonus. So let's look at our slide. This is the formula. Future value is equals to PV to bracket 1 plus R raised to power N. As we stated earlier on in the previous slides, this is to get your discount rate. This is the formula. Then plug in all these values into the formula. So the discount rate used is 69.63%. So this is another example. After receiving performance bonus of 850,000 naira, then Mr. Muritala decided to purchase a SUV that worth 1,850,000 naira. However, he needed to borrow 1 million from his sister to make up the SUV purchase price, and he has promised to pay her sister 1,350,000 naira after 3 years. So with annual compounding, find the implied rate of interest for this loan. So look at the slide. The future value is 1,350,000, the present value is 1 million, and N is 3. So our how, just plug in all these figures into the formula. Then the rate is 10.52%. Likewise, this is another example. Mr. Muritala opened a bank account for his brother in Chop Life Bank, and Chop Life Bank pays 5.5% annual interest, compounded monthly. How long will it take the money to double in his account? So this is the formula. Look at this slide. Our PV is 1, future value is 2, R is 5.5, which is prorated to monthly rates. Then this is the formula. This. Then our N is 12 years, 8 months. So this is another example. Suppose Mr. Muritala brother deposits 350 naira at the beginning of each month in an account that pays 6% annual interest, compounded monthly. Find the total amount in these accounts at the end of 25 months. So the monthly rate of interest is 0.005. Then you consider the first deposit of 350 naira, which is future value after 25 months will be 350 into bracket 1.005 raised to power 25. Raised to power 25. Then the second deposit, which is a month late, we have 20. After paying the first one, we have the 24. We have minus 25, which will give us 24 months remaining. So, and its own future value too will be 350 into brackets 1.005 raised to power 24. However, in a similar way, we find that the last deposit has just 1 month to earn interest. Putting it all together, the following expression gives a total at the end of the 25 months. You have this. So this is the final answer. Future value is 9,342 naira 17 kobo. So this is another example. Suppose the price of a house that you're interested in buying is 100,000, and you have your 15,000 down payment handy. The bank will loan you the remaining 85,000 at 8% annual interest for a 25-year term. Find your monthly payment. So this one is a typical example of annuity. So since the discounting frequency is a discrete discounting, the discount rate will be converted to a monthly rate. Likewise, the payment tenure. Therefore, the annuity formula will be this. Present value PV is C, which is our cash flow. the equal cash flow, the equal series of cash flow, which is also the annuity payment, into bracket 1 minus bracket 1 plus r over m bracket raised to power minus nm over r over m. So just plug in all our values into the formula. So the annuity payment will be 656 naira and 4 kobo. So this is another example. You have just opened an IRA in which you plan to deposit 100 naira a month. At the beginning of every month, the IRA will pay 9% annually. With monthly compounding, approximately how long will it take you to accumulate 20,000 naira in this account? So this is the solution. Look at the slide. So at the end of the day, it will take him 122 months to accumulate 20,000 naira in his account. So this brings us to the end of this course. However, please do not forget to hit the subscribe button, as we promise to give you simple solutions to difficult topics. Also share with fellow students, colleagues, family and friends. This is our maiden video on YouTube, so please encourage us by subscribing to our channels and also inviting your colleagues, students, friends and family to subscribe to our channel in order to give you a very simplified solutions to all the difficult topics in finance. So thank you for your time. I appreciate the time you've spent in watching this video. So in case you have anything to discuss or any further discussion pertaining to this topic or any topic in accounting and finance, you can contact us via WhatsApp or our Instagram or via our email address as shown on the slide. So thank you once again for your time. I am Rasheed Busari for Bralock Solutions Limited. Thank you.